Good morning, ladies and gentlemen, and welcome to the show. Today is Monday, the 11th of November, 2019. It's a nice day outside, and we're going to get started. We're going to open up the charts right here. Now, you know the Chinese. Former chief trade negotiator, he says that Beijing, which is China, wants Donald Trump reelected because he's easy to read. In other words, what they're saying is he'd be easy to win against in a game of poker because he gives away his hand. It says China's former Vice Minister of Foreign Trade, Lu Yongtu, says China wants Donald Trump to be reelected because he's easy to read. He says Trump's vocal nature and his unfiltered tweeting make him the best choice for an opponent for negotiations. In other words, they can figure him out real easy, and so that they can try to get the best of everybody in the West, for the policies of the East. So, I don't know if that's really true or not. I think that Trump, when he makes a tweet and stuff, that they think they might have him, and they think, hey, you know what, we know what he wants and everything else, but Trump might be tricking them, Have they ever thought of that? He might not be as easy to read as they think. Anyway, let's take a look now at Deutsche Bank. You got to keep our eye on Deutsche Bank. It's been starting to fall a little bit lately, and it's no reason to me. It's not rocket science why Deutsche Bank's falling. They're undergoing what they call a restructuring. But really what it amounts to is a downsizing. They're making their business less profitable by chopping it to pieces. And ultimately, in the end, they're laying off like employees left and right, and they're chopping different divisions off of their bank, like that were once profitable, and they just keep shrinking down smaller and smaller. And this is a last sort of a ploy to try to maintain credibility and try to stay afloat and not go bankrupt. Anybody out there is buying Deutsche Bank stock, you better think twice. If you think Germany's really going to step into the breach and try to save this bank, you might be kidding yourself. Germany just might let this bank roll over, because they can actually absorb the loss. It would be a big loss to the world banking picture, but we might be facing in the not too distant future some sort of a ultra large Lehman moment when Deutsche Bank finally really goes down. And what it's going to do is it's going to catch all of us by surprise. We're going to be all caught sleeping. It's just one of these mornings we're going to wake up and it's going to be on in all of the media that Deutsche Bank has fell. And that's the way it's doing. It's sneaking up on us. Let's take a look now at something else I found very interesting today. If the page will come up. I have to quit this page, perhaps, to get it here. Iran found new oil, and this isn't ordinary new oil in Iran. This is a massive discovery of new oil. It's just been announced by Iran. 53 billion barrels. Now, to put this into perspective, if they pump 2 million barrels a day, that's a big oil sale, 2 million barrels a day. That would put them on the list of the larger countries producing oil, larger oil producing companies. If they pump 2 million barrels a day, it's enough to last 72 years. That's how much oil is there in this oil field that they just discovered. That's an enormous oil field. Let's take a look now at the silver price today and see what it's doing. $16.85. Now, there's some sort of a strange anomaly on here. I don't know if it's real or not, where the silver price spiked up to $23.50 and then spiked right back down again. I don't know. Is that real? Did that really happen, or is that just on this particular chart? I'll look into that and see what it is. But today, we're up 8 cents on the day so far. We're at $16.80 now. If you guys have been following gold and silver, we had a tremendous smackdown in the price, you know. You go back a couple months ago, we had a silver price of $19 and change, 1915 or something like that, and now it's 16.85. There's no reason to assume right now that the economic conditions have changed. It's just investors out there have breathed a sigh of relief, but basically over nothing. Nothing's really changed. It's just media news and stuff that maybe we won't go into a recession and stuff, and they've breathed a sigh of relief, and investors have basically are risk on again. That's what's happened. They're right on there, risk on. They're into the same old stuff that they were into before, and they've dropped their gold and silver, and they're on to something else, and they think the big rally in gold and silver's over. This fear in the marketplace is going to come back with a vengeance. It's going to come back to bite them, you know, and in a not too distant future, because we are in a global Ponzi scheme right now. And there's only one direction that this can go. Well, there's actually two directions it can go. It can go down all the way down and slide all the way down the mountain into the pit. And then a big puff of smoke comes out of the pit. It can go that way. They're not going to let it go that way. Or it can go up and up and up to infinity until it reaches the heavens with modern monetary theory. But your dollar, by the time it gets to the heavens, all these markets, your dollar will be absolutely worthless, or basically nearly worthless. So those are the two directions. They're going to take the direction to keep propping this system up. They're never going to let it fail entirely. And I hear economists out there saying the best thing to do would be to let the system fail, let the excesses come out of the system, you know. They'll never let that happen. They're just going to keep adding to this Ponzi scheme. And of course, because we're in this point where it's just going straight up now, all the debt is just going straight up. Once it reaches a certain point, they don't care anymore. You'll hear no more talk about balancing the budget or anything like that. Once they hit a certain point, they'll be just on a mad, fervent rush to the sky's the limit. And, you know, that's where we're headed. That's where the hyperinflation road. Let's call it the hyperinflation road and the great print. Let's move on to cryptocurrencies. Oh, I forgot to look at gold. Gold. Today, 1462. Isn't that awful? Because, you know, we were up above $1,500. And this has been but it's up $3.40 on the day so far. So there is a bright silver lining on the end of that cloud. Now let's take a look at crypto. Basically, there's not a lot to see here, guys. Crypto is basically going sideways. It's at 239 billion with a Bitcoin dominance of 66%, and Bitcoin is actually 87.47. It's going sideways. That's what's happening today. Let's take a look at the Dow Jones today. And it's down 138 points on the day. Yeah. But, you know, I call this a Teflon market. You know, it went along sideways for the longest time. It made a peak back in 2018, back in January 22nd, 2018. And it made that same peak again, and it basically made the same peak again, and now is the first time it's really starting to leave that spot into new territory, new higher territory. Well, let's see how far it'll get. Now let's take a look at oil. Oil's down 89 cents on the day, 1.55%. It's at 56.35 for sweet light crude. And let's move on to U.S. Treasuries, and we're seeing this bounce back. And now I forecast this bounce back in treasuries, but I think it could get a lot worse. We got to keep our eye on the 10-year. It's at 1.945. It's went up quite a little bit. You can see the turn if I go on this chart right here, and I'll show you the turn in the 10-year. It basically bottomed out and turned. And we can see that the turn was back around not quite a month ago, I guess, or so. It turned. The price changed and turned. We can see it bottoming out and turning up. Let's focus in on that just for a second here. You can see it bottoming out and turning up. Right there. Right? And we're at 1.945 right now on the US 10-year. And we got to watch this price because I've predicted if this price goes above 3.25, big trouble. Big trouble. And, you know, you think it can never make it there? It can make it there so fast. It could make it there in 2 weeks. If it starts to really take off. These treasuries start to really, the yields really start to fall and the treasury market starts to fall out of bed. Now let's take a look at U.S. dollar index. And we got a falling dollar index, but starting to turn up now. 98.18 on the U.S. dollar index. But you know, guys, we got to really keep our eye on Deutsche Bank. I just got a feeling over the next number of weeks, the Deutsche Bank might start rolling over. And who's going to come in to actually save Deutsche Bank? Germany is very, they're not likely to rush in with any big, heroic efforts to save Deutsche Bank. Quite seriously. And it's not so much Deutsche Bank's, if Deutsche Bank goes down, it's not so much Deutsche Bank's derivatives books that's going to cause the biggest problem. It's their debt obligations. These other countries have got themselves involved, like something like 58 different countries. I forget exactly how many it is. Have got themselves involved with Deutsche Bank, you know, and collateralized debt obligations and things like that. They've got themselves tied in, and this might be actually the bigger problem. And Germany would have to absorb a $400 billion Deutsche Bank problem, basically, you know, which the German economy probably could handle it, but the pall it would create the entire world when it goes down would have a very adverse effect and reaction upon the world's financial system, which is already starting to roll over from one of the longest expansions in history. I mean, we get recessions on a regular periodical period, and this thing now has passed into, like, delayed itself. It's ready to happen, in other words. And so Deutsche Bank going down would probably trigger it to happen. And so that's what we got to keep our eye on, Deutsche Bank. Listen, thank you guys for listening to my show. Give me a thumbs up, and we'll see you guys very, very soon. Bye-bye.